Credit unions operate as member-owned financial cooperatives, applying capital to real-world needs through disciplined, accountable service. Millions of Americans stand outside the traditional financial system. These are students, essential employees, and thin-file workers who urgently need affordable transportation just to participate in the economy. Traditional starter loans offer a way in, but they carry a severe structural limitation. The moment the loan is booked and the funds are dispersed, the lender loses all visibility. There is no ongoing evidence to show whether the financed asset is being used productively. We see this play out in the rapidly expanding e-bike market. Generic point-of-sale lenders will happily finance the transaction at checkout, but they completely ignore the behavioral relationship that follows. Until institutions can verify productive behavior after origination, credit unions are structurally blocked from safely scaling starter lending to the individuals who need it most. The solution requires moving past a static, one-time application snapshot and building an evidence ladder of verified behavior over time. It begins when a new member opens an account and receives a credit union-branded NFC credential. This credential becomes part of the daily commute. The member performs a physical action, tapping the card at the start and end of their ride. By logging the specific time and location of these start tap and end tap events, the VIDAT system converts a physical gesture into a discrete ride session. This creates a sequence of verified data points, building a repeatable, audit-grade chain of evidence for the lender. For an active rider commuting just 12 days a month, that generates nearly 300 branded credential interactions over the course of a single year. Instead of a passive loan collecting dust in a file, the e-bike becomes a daily, top-of-wallet utility that physically connects the member to the institution every time they ride. But how do you take a physical commute and translate it into a format that an underwriter can actually use? This chart shows the Behavioral Reliability Score, or BRS. It takes raw verification events, like ride frequency and route adherence, and mathematically evaluates the rider's commuting discipline. To be clear, BRS is not a FICO score, a promise of repayment, or a replacement for affordability analysis. It is supplemental behavioral evidence. A pattern of verified ride sessions demonstrates consistency, follow-through, and continuity from borrowers who may have a thin credit file. Armed with this data, credit unions can evaluate repayment performance alongside verified mobility behavior, allowing them to proactively coach members and identify exactly when they are ready for their next financial product. Relying solely on raw TAC data presents an immediate problem. Not every member rides through the same environment. One borrower might have a predictable route with protected bike lanes and secure parking. Another borrower faces heavy traffic, poor lighting, extreme weather, and a high risk of theft. To account for this, the Infrastructure Adjustment Index, or IAI, provides crucial fairness context. It separates verified member behavior from external corridor conditions. A lower ride frequency doesn't necessarily mean a borrower is unreliable. It often reflects infrastructure constraints completely outside their control. By applying this disciplined review layer, credit unions can deploy inclusive starter loans that align with fair lending practices and withstand rigorous model governance. Zooming out from the individual commute, there is a rapidly closing window of opportunity at the macro level. This chart projects that between 2025 and 2028, the U.S. e-bike market will reach nearly 7 million units. The goal isn't to capture every single transaction. The strategic value is securing the inclusive segment, the younger members and essential workers who need affordable transportation, before frictionless point-of-sale platforms dominate the relationship. To execute this at scale, credit union service organizations act as deployment multipliers, standardizing the policy, compliance, and implementation architecture across dozens of local branches. In this structure, the technology operates in the background. The credit union retains full ownership of the member relationship, the loan book, the deposits, and the interest economics. This system is entirely removed from lead generation checkouts or consumer wellness apps. It is a verified audit-grade framework that pairs mobility and credit building to grow membership and fulfill the credit union mission.